Hello everyone, hope you're all well. I'm Jeff Ando, Content and Production Director at GTR, and I'm delighted to welcome you all to the latest in our series of GTR webinars, this time focused on the new challenges being faced across the insurance market. The coronavirus pandemic has of course raised questions throughout the entire trade community over the role of insurance in supporting companies and facilitating bank lending, whether it's trade credit, structured credit and political risk, or the export credit ECA market. We'll be addressing all sides of this over the course of this webinar. A quick spot of housekeeping: as per other GTR webinars, we'll look to keep things interactive, so please do use the Q&A facility, which you can find at the bottom of your screens, rather than the chat function, which we won't be using, to pose your questions to our speakers. We have time allocated at the end to run through these, so please do get involved. I'm delighted to firstly be joined by my colleague Eleanor Ragg, Senior Reporter at GTR, who's going to lead some of the discussions here. Eleanor, welcome. You've been writing extensively about the situation currently faced by the insurance market, so perhaps you can share a bit more about that first to kick us off.
That's right. So as policymakers have pulled out all the stops to prevent economic collapse in the face of COVID-19, insurance has become of prime importance to maintain businesses afloat during lockdowns and keep trade moving, even as both demand and supply around the world are buffeted by shocks. So we've seen that, export credit agencies have burst into action in Europe, the US, Africa, Australia. We've seen the private market, the whole turnover insurers all come together to support exporters and financiers alike. Now in this session, we're going to be talking to three very different kind of angles of the market. So in our first session, Vinko David, the Secretary General of the Berne Union, the Global Association for the Export Credit and Investment Insurance Industry, is going to talk us through the export credit industry's response to the crisis. So outlining the impact of COVID-19 on trade risk and the importance of supporting trade credit insurance to facilitate bank lending. Then in our second session, we'll take a look at the response from the private insurance market to the challenges presented by COVID-19. Now let's not forget, trade in the global economy relies on a variety of insurance products, so public, private, whole turnover, single risk, and all of these cater to specific market requirements. So in our third session, we'll take a look at the need to harmonise the market in times of trouble, and the need for the insurance industry to speak with one voice. And then finally, we'll close off with an analysis of some of the points raised throughout the course of the webinar and run through the questions posed by the audience. So I'd like to hand over now to Vinko David so he can talk us through the view from the export credit community, how swiftly the support measures have been introduced, whether capacity has been maintained, and how ECAs are reducing pressure on obligors.
Well, thanks, Eleanor, and welcome everyone, wherever you are in the world. The main topic of my presentation is the very reason why we are not meeting face-to-face, and that is the corona crisis, of course. And in this presentation, it's about 10 minutes, maybe 15 minutes. In this presentation, I want to share with you what impact this pandemic is having on the credit insurance industry. Many of you are familiar with the role of credit insurance, and I won't dwell on it for too long, but I want to show in the next slide what the Berne Union stands for. So it's a short recap of the role of the Berne Union and credit insurance industry. In the Berne Union, exchange of information is the most important raison d'etre. We do that internally, but we also share the information with other stakeholders in the industry, and much is published as well on our website. You can simply download it. Industry statistics on underwriting, on risk, on claims, etc. Every 2 months, we publish a bulletin with thought-leading articles on the industry. We are also in touch with policymakers, trying to raise awareness about the importance of our industry. and the role it plays in creating value, adding value to our economies. And we reach out to other stakeholders that can be commercial banks who are often insured under our policies. It can be development banks, sometimes development banks and commercial banks supported by insurers are in the same projects. It can be factoring companies. Factoring companies are important off-takers or takers of credit insurance. Now, most of you will know, but just to say it perhaps again, the Berne Union unites both export credit agencies, the public insurers, and private insurers and multilateral insurers. Last year, our members insured for about $2.5 trillion in cross-border trade. Well, so much for the Berne Union. I will move to the next slide, and that is really the impact of the current crisis on the economy. As credit insurance is an important support for trade, it also plays an important role in this cycle, this almost vicious cycle of what is happening now. Credit insurance protects exporters against non-payment by their customers. It unlocks bank finance, and it facilitates exporters to explore markets which otherwise they would find too risky, so it helps them expand. Now, this function threats to be broken if no measures are taken, and a lot of measures are being taken at the moment. This downward spiral. Let's start let's start by saying that this is different from the global financial crisis 12 years ago, which was essentially a financial crisis. This is not a financial crisis, at least not yet. It may turn into a financial crisis, but at the moment it's a demand and supply crisis. And both sides, both demand and supply, have crashed temporarily. Factories have closed and transportation has halted, and this disrupts the supply chains. In a globalized world, it is important to realize this, as many end products have multi-step supply chains all over the world. But also, that's the supply side, but also the demand side has slumped. Consumers in lockdown spend much less, and so do many companies. They spend much less. So all of this affects the cash flow of companies. They are simply running out of cash. And this will lead to more insolvencies on its turn, which triggers a domino reaction. The insolvency of a buyer may cause the insolvency of the supplier. So everyone runs the risk of running out of cash. And this means that for banks, for credit insurers, the payment risk for lending and insurance has increased. And as is logical, both banks and insurers do not want to throw money to a house on fire. So this could potentially mean less liquidity and financing capacity for exporters if no action is taken. And let me also say that you have to be a bit creative to think of action, because both banks and private insurers and ECAs are under strict regulation, actually regulation that has become stricter after the global financial crisis. So what to do? And that's what we see on the next slide. The credit insurance industry, both public and private insurers, have acted robustly and quickly to keep capacity up. The main measures are grouped into 5 categories. That is support to exporters, maintaining capacity, keep the cash flow, minimize default, and also some non-financial support. If you look at the first one, and that is really across the board among Berne Union members, so both ECAs and private insurers. Increased flexibility for both policyholders and buyers. So if there was a need of extending payment terms, it was approved. Some have sped up the claims handling processes. Sometimes there were waivers. There were also some waivers on fees by ECAs. And then capacity, because that is at the moment perhaps the major concern. Can we keep up capacity in this time where this capacity is dearly needed? And here what you see is a great cooperation between the public market or governments at the one hand and commercial insurers at the other hand. Especially in the short-term arena, a lot has been done, both in the European Union, but for instance, also in the US, whereby ECAs or governments are reinsuring private insurers. This has not yet been formalized or finalized in many countries, but the structure is there. And actually here, the governments and the ECAs have listened to private insurers what was needed to keep up trade finance capacity. Especially ECAs, in addition, have also taken some other measures. For instance, increased covered percentages or larger share of the transactions they were prepared to cover beyond 85% of financing. So a lot has been happening there. That is one thing that is related to the buyer risk, but also the exporters themselves face difficulties. They face liquidity issues. So many ECAs have set up or extended working capital programs, have extended their bond cover, have even entered into domestic supply chain cover. If a domestic company supplies to an exporter, to a national exporter, and that exporter then exports, and also this transaction, this domestic transaction, can sometimes now be covered. And there has also been some product innovation that actually started in China, but has spread. China in January, February, desperately needed medical supplies, which they had not sufficient capacity to manufacture themselves, so they needed to import. But in this market, these imports needed to be paid in advance. So the importer runs the risk that the payment is gone and he doesn't get the supplies. So now also import guarantees for essential supplies have come into force, covering the importer against the risk that for a paid supply he will not get delivered. Then minimizing defaults. Both ECAs, as said, and private insurers have accepted the deferral of payment. Now, this started with, say in the trade credit arena with 15 days, but it's now moving up to 1 month, 2 months. I also want to mention here something which is a bit more complex. That's a G20 initiative for deferral of payments by the about 70 poorest countries in the world. If the debt was a public debt and if the debt was covered by ECAs, there has been an agreement in the G20 and the Paris Club for this. How this exactly will pan out is not yet sure. There's a lot of discussion about this. But at least it shows the willingness of public creditors to help these countries, and also private creditors and unsecured banks have been asked to participate, and they have already, well, shown their willingness to do so if some more details are worked out a bit more clearly. And then lastly, what did insurers do to help the insured exporters? Help desks with quick access to the insurer, more digitization in the whole process, less paperwork, and that has also helped. So all in all, a lot has been done in a very short period, because please remember that this only started in February. It looks ages ago, but the whole insurance industry and governments have acted quickly. More things need to be done probably, but this is a very positive sign. The whole market has acted much faster than during the global financial crisis 12 years ago. We really have learned from the previous crisis, and that's maybe a good thing, and hopefully we will have learned more from this crisis. Lastly, I just want to share with you, and that's on the next slide. As said, we do share reports, thought-leading articles. We published 4 weeks ago a report on the measures that Berne Union members have taken in response to the Corona crisis. That report is available for all of you under our data report tab. So please have a look if you want, and please have a look at all the many measures that the credit insurance industry has taken so far. Thank you.
Thank you very much. I think one of the key messages there that we saw is that the export credit industry and export credit insurance industry's response has been rapid and robust. And as you said, this isn't the global financial crisis. However, some of the characteristics are similar. We've seen liquidity issues, payment risk, insolvency. You mentioned that lessons have been learned and are being applied from the global financial crisis. Could you perhaps expand on that a little bit more and maybe point to potentially where capacity is being maintained, where it could be increased, and where there may be more that could be done, taking into account what we learned 12 years ago? Yeah, 12 years ago, please keep in mind, most trade in the world is trade credit. It's not really medium and long-term export credit. Yeah. So, what measures were taken in the previous crisis? First, the discussions between public insurers and governments at the one hand and private insurers started up much slowlier. Second, what has been very helpful here, especially in the EU, is that the European Commission suspended the list of marketable countries from the short-term communication. And that has provided an enormous dynamism to ECAs and private insurers to work together. So that's one thing. The European Commission has acted much faster in this respect. Second, in the previous crisis, there was a bit of experimenting how the private market and ECAs could work together, whether that was through reinsurance, top-up insurance, or by ECAs being the primary insurer. Now, they were experimenting. What we have learned from the previous crisis, and that is now being applied, is that top-up insurance by an ECA or direct insurance by an ECA would not work. Direct insurance would not work because it disrupts the existing policy, the existing relationship, and very often ECAs don't have the capacity to be the primary short-term insurer or turnover insurer. Top-up insurance didn't work because it was simply too complicated. You had two types of cover. First, the cover by the commercial insurer, by the private insurer, and then a top-up by the government. And they were simply not dovetailed, at least not for the export, and that made it very difficult. So this time around, focus was on reinsurance, reinsuring private insurers by ECAs, and thus keeping
the policies in place, no disruption for the exporter. That has been learned. Second thing that was learned is that ECAs themselves very quickly realized that biorisk was a problem, but the more immediate problem was the cash flow of their customers, the exporters. The exporters were running out of cash flow. So this time around, ECAs have very quickly expanded or set up working capital programs to keep up the cash flow, the liquidity to the exporters.
Fantastic, thank you very much. Moving on now to the private market. So since the COVID-19 outbreak began last year, we've seen new challenges for insurers and brokers alike as they seek to support corporates, banks and traders. Now, I'd encourage you, if you have any further questions for Vinco, to send them through via the webinar function. Meanwhile, we'll now hear from Sean Aspinall, Managing Director at BPL Global, and Peter Sprent, Head of Financial Risk Solutions at Liberty Specialty Markets, for their perspective on how the market is reacting and how the sector is dealing with the current situation. So, even before this COVID-19 outbreak began to roil supply chains, we'd already seen a huge fall in oil prices, which was battering trade volumes around the world. So given this double whammy of these two external shocks, what can you tell me about the extent to which you will see a wave of insurance claims coming through? Sean, if you'd like to go first.
Yes, thank you. Very nice to be with you today. So really, we're in the phase of trying to predict, but without any certainty, what we're likely to face in terms of the claims environment. However, I think it's obvious that given the liquidity is going to be under severe pressure, that it is definitely something that is likely to follow. And but at this stage, I should say that at this stage that we personally are not handling any COVID-related claims activity. To date, what we've been seeing is very much waiver requests for covenants. Obviously, that is quite creates quite a lot of workload. It's quite labour intensive to field that, both obviously through the network and for the insurers to turn those around. However, I would say that the insurers are very good at doing that. They understand the expectations of the client base and the market and what the market needs to do to get back to insureds in time so that they're not actually holding up the situation. But yes, I think you're right in terms of the exposure to the oil sector. I mean, I would say our market has always been disproportionately exposed to the oil sector. However, there has been a significant correction in that in the last few years. So, but I would say that probably last year 60% of our inquiries emanated from the oil sector. And then obviously if you then impact that with all the stresses that are currently being faced from the COVID situation, we are obviously going to see a wave of claims activity. But at the moment, we don't know where the government support's going to go. We don't know whether we're going to be dealing primarily just with restructurings or whether there will be a significant wave of claims, actual claims crystallising. But it is a little bit too soon to tell. However, the market has an exceptional track record of handling claims. Since the global financial crisis, the market has settled just to financial institutions alone over 3 billion in claims monetary values, and with minimal sort of compromised situations. 97% of those have been paid and in full and on time. So obviously everybody will be having a preparation period. At least we have some time for everybody to prepare themselves for what's likely to be heading in their direction. But at the moment, as I said, it's a little bit too early to be able to determine any particular patterns within that or timing in terms of when that wave will hit.
Thank you. Now I've seen, numerous pessimistic estimates of loss scenarios due to the COVID-19 pandemic. Peter, from your point of view, what's the likely impact on the health of the market as a result?
Good morning. Thank you. Hi, everyone. Yeah, as Sean was saying, I think it's sort of inevitable that we're going to face a wave of claims. I think various industry leaders have stated that, including Lloyd's, that this probably will be the biggest insured event in history, about $100 billion of losses on the liability side of the balance sheet, and probably another 100 billion of investment losses on the asset side of the balance sheet. But currently, the way it seems to be, the way I'm reading it, and the comments that from the various rating agencies, etc., that this is more of an earnings event than a capital event. So I think there will be significant earnings challenges over the next couple of years, and those losses are going to take time. Well, some of them will take time to come through. So I think the losses seem to be falling into three different categories. Those ones which are appearing almost immediately, like sort of event cancellation type losses, and it's going to be the biggest ever loss for that market, the sort of contingency market. But then the trade credit losses, I think, will fall into the sort of next wave. So even though trade credit is an area that's been mentioned along with contingency as one of the main contributors of losses, they're not coming through, as Sean mentioned, straight away, and we wouldn't expect them to be honest. I think it will take 2 or 3 years, and it's difficult to tell, partly because of this, the enormous amount of sort of government intervention in markets desperately trying to keep companies afloat and economies going. So it's not a usual sort of crisis from that perspective. We obviously haven't seen that before. So I think it's going to take longer. I think we'll be seeing credit losses coming through for 2 or 3 years. And then there's that third category, which is sort of the known unknowns. There are going to be claims in areas like casualty and business interruption, but they might take longer to feed through. But overall, I don't see it as being a major challenge to the industry as a whole. We're seeing companies that see an opportunity raising capital effectively, and the market seems to be operating efficiently. Insurance pricing generally was going up. There will be further increases in pricing being driven by losses in the market. And so the only government intervention so far, which is a positive rather than a sort of a bailout, is what Benko was mentioning around the support by government to try and keep trade credit limits available and open for credits that otherwise, might not get support because they're looking pretty challenged in the current environment. So that's a very positive intervention at the request of insurers, as opposed to government's need to step in and bail them out. But generally, I think at the moment it's looking like the insurance business will is well positioned and in good shape to wade this current and coming storm.
Fantastic. I'll come back to your point on pricing in a bit, but initially I wanted to speak now to Sean. So from a broker's perspective, how do you see the market reacting currently, and does appetite still exist?
Yes, I mean, obviously none of us have been through anything like this. So I think there was no ability to actually predict how a market would react in this type of scenario. But actually, to date, I would say it's been a measured and positive reaction in terms of the ability to maintain a balanced sort of measured ship through this. And I think there was the first 2 weeks where obviously when everybody went into lockdown, I think that was a period when there was a huge pause while people obviously not least tried to work out how to actually access their files and their workplace from home. I think the market has reacted very well to that. I think it's functioning very well. I think in terms of business that was pipeline pre-COVID, the market has kept their nerve on that, working with clients and working with the insurers. We have managed to navigate through that and close that business to client satisfaction. In terms of new business that we're seeing now, obviously everybody's somewhat hampered in terms of obviously originating, business at the moment, not least from travel beyond anything else. And so far in April, we saw a 25% drop in inquiry level, but I don't think you can actually determine any trend from that yet. I think it's too early to determine that. However, we have, in terms of insurers' appetite for new business, we are getting indications across the board. I would say there are, obviously we're talking about 60 different players within the single situation credit market, and of those you are always going to have different appetites. So you have some insurers that have gone on hold at the moment in terms of a watching brief for new business, but they are the minority, by far the minority. All of the bigger players are determining how they navigate through this and realigning what their appetite now is, and trying to communicate that clearly through to the client base. And it will take a little bit of a readjustment in those appetites, and also in pricing, as we've touched on before, because obviously there's an expectation with heightened risk because there's inability to determine the exact risk level at the moment. Pricing is obviously under an upward pressure, but it is on the client side as well, and it's whether or not those two sides align in terms of their pricing models and cost of funds, etc., in terms of being able to harmonise going forward. But I would say to date, performance has been surprisingly good. The market is definitely keeping its nerve, and we are receiving indications and receiving significant levels of inquiries throughout, which is the only obviously barometer that we can go by at the moment in terms of testing the appetites.
Fantastic. And Peter, from your side, what kind of business volumes have you seen, and how are you dealing with this crisis?
So yeah, I mean, as Sean said, the initial sort of focus obviously was trying to make sure that we could operate as much as possible, business as usual. We've got about 45 people in the team around the world, so people being affected in very different ways, some more extreme than others in terms of the lockdown, etc. But you know, we got up and running from a work from home situation very quickly, and it's been an incredible effort, as I'm sure we'll all have experienced from our teams around the world. But I've been amazed actually at how quickly that we were able to do that, and how relatively efficiently we've been able to manage the business. Like everybody, I'm sure we're all spending far too much time on Skype and Zoom, etc. Probably more than we need to, but that will, I'm sure we'll get better at it. I mean, initially, yeah, so that was the focus, making sure that we could operate business as usual, electronic signatures, being able to bind contracts, etc., etc. We obviously had an additional level of attention sort of on the portfolio management side of the business, trying to understand exactly what the impact would have, lots of different modelings with all the different scenarios that's discussed. But that was really sort of going on in the background. So our main focus was engaging with the clients and brokers, really trying to you know, understand the new business pipeline and try and deliver on those transactions, which some of our transactions are 2 years in the making. So wherever possible, delivering on our promise and try and get those transactions closed, which generally speaking, I'm pleased to say, I think we've managed to do. I mean, generally speaking, I think the thing I've struggled most with is just at the level of uncertainty. I think this crisis feels a bit different to previous ones we've been through, and old enough to have been through at least 2, probably 3. So yeah, it's that, and these we're all operating within, when you look at the IMF economic outlook or the S&P outlooks and the scenarios, and we've obviously developed our own, and there's these 3 different scenarios effectively we're all sort of looking at in terms, depending on the length of the lockdown. And I think that's the real challenge, is trying to get a line of sight as to where we think we're going to be, and therefore, you know, plotting your way along that. But in terms of actual activity, we hadn't prepped this, but Sean, I think you said your inquiry level was down 26%. Did I write that down correctly?
Yeah, you're probably right. I gave a rough 25 just now.
25. Okay. So yeah, I looked at ours. Ours is down is 28% down. So we've handled around 1,400 inquiries in the last 3 months, the majority of which we've obviously been in lockdown. And so we quoted or indicate on an over $2 billion of notional limits from those inquiries that we've seen, and closed around 150 transactions in those 3 months. So even though we haven't been able to do everything that we'd probably like to do, we've done the best we can at trying to, as I say, support the market and keep open and keep trading. So those are pretty significant numbers. So, and I'm pleased to hear from Sean that the market overall is responding very positively. So in terms of year-on-year activity, that's certainly slightly down on this time last year, but overall, considering the situation and that uncertainty that I referred to, we're pretty happy with the way we're trading at the moment.
I'm just conscious about time, but I do have a couple of really quick questions for you. I did want to touch back on that point about pricing. So looking ahead, what challenges do you expect to see around pricing in industry sectors? And do you think insurers are going to need to rethink their business model to stay profitable?
So I'll take that one. I'll try and be quick. So generally speaking, insurance is going to be a more difficult business to make money in. Capital costs are going to go up, both actual capital and our contingent capital in the form of reinsurance, as the business has tried to absorb these losses, and there'll need to be a sort of an opportunity to try and sort of earn that back, if you like. Insurers will also find it a lot more difficult to generate returns on the asset side of the balance sheet, which is generally where, certainly in recent times, underwriters or insurers have generally made more money on the investment portfolio than on the underwriting portfolio. So there will be a new emphasis in a broadly, negative interest rate environment that underwriters are going to need to make an underwriting profit, which they generally haven't always done. So more focus on that. I think there's also going to be an additional focus on costs. I don't think it's sort of cost or price. I think we're going to have to work on both, as I think everybody is across the different industries, both direct and indirect. I mean, one inevitable consequence of the lockdown is that none of us are traveling, none of us are, are going out. So T&E expenses, that's an immediate sort of bonus impact, if you like. That's one positive. But yeah, I think we all felt the credit cycle was coming to the end of its sort of very sort of full run. So we were expecting some sort of adjustment, I think, in credit pricing anyway. Obviously, none of us saw this coming, and it's more dramatic than we thought. But I think wherever we talk to across our client base, whether that's corporates, banks, multilaterals, I think everybody sees the need for a sort of bit of a readjustment on risk pricing, bearing in mind the environment we're going to be in and the losses that we're going to have.
Thank you very much, Sean. Just to close up, just sort of given this sharp increase that we've talked about in payouts and in investment losses, do you expect to see cover being withdrawn, or do you think the market is in a position to honour its obligations?
I think the majority of what we actually look at is more the single situation market, where cover is effectively non-cancelable for the life of risk. So for the majority, obviously, the business we're looking at, I don't think, obviously, there is no ability for the insurer to withdraw cover on that aspect of the business. However, obviously, you do have to renew some of these facilities we have for RCFs, etc. And whether or not the market actually sticks with those going forward, I think is probably the bigger question. But I think there is a real feeling through this of an element of relationship too. Some of the biggest market customers, there are very strong relationships within the market. So I think that will serve to temper any level of abject withdrawal by the insurers. But obviously everybody's looking at balancing portfolios and getting balanced books. And slightly going back to the sort of pricing issue on that, obviously the insurers are not typically price makers within the market. They're sort of, their pricing models give them the ability to accept or reject the risks, but ultimately the transactions, it's more a harmonization of the pricing between sort of the finance sector and the insurance sector, and whether or not we get that harmonizing so that the insurers are comfortable fitting within the revised pricing that's being proposed on the financing side, and it's whether or not we get that harmony. So I don't expect abject withdrawals from the way the question was structured, but in a more subtle way, I think there will be sort of slight movements to realign into maybe away from certain sectors into different sectors, whether or not pricing supports the volumes that were previously done or not. I think they're the areas it's much more nuanced, I think, than rather an in-out type scenario.
Thank you very much. I'd now like to introduce our next panel, which will be looking at harmonizing the market in times of trouble. So, as I said in the introduction, trade in the global economy relies on a variety of different insurance products. In the last session, Sean and Peter have talked about the private market, and now Carol Sale from Texel Finance and Robert Nyhoot, who's the Executive Director at the International Credit Insurance and Surety Association, ICISA, are going to talk a little bit more around the single risk insurance market and various differences therein. So Carol, if I start with you, please, how does the single risk insurance market fit in to this bigger picture? And what is the difference between that and the whole turnover market in this context?
Oh, well, thank you, Eleanor. And it's great to be here this morning in this webinar, and great to listen to Vinko, Sean and Peter as well. So there's a little bit of overlap in some of what I'll be saying, because I think Sean has already really identified a very key difference between the single risk market and the whole turnover market. And I think it's important to identify and split the market by product and look at the providers, because that is really how we do differentiate between these two markets. And there's a lot of differences in everything that's happening that flows from this. So on the one hand, you have the trade credit insurers who predominantly support the export or sale of goods and commodities on a short-term basis, and normally offering their product on a whole turnover or a named buyer basis. In this market, insurers can cancel limits or reduce levels of cover, and it's typically this market that is better known and hits the news in time of crisis. And it's dominated by the three big monoline providers, Coface, Atradius, and Euler Hermes. And they cover only this type of business, and they're a powerful force because they're very well organized, and it's concentrated in these three main players. And of course, the market that Sean is talking about, and the one that we work in as well on the other side, is the structured credit insurance product, where there are 60 plus players. It comes with many names: non-payment, single situation. But the main users of that product are the commodity traders and banks, who are using this not just for credit risk, but also for various regulatory capital optimization or balance sheet protection. And that product, as Sean mentioned, is non-cancelable and has longer tenors with policy sizes running to hundreds of millions. And it's that area of the market that I think is a bit more difficult to mobilize and address, because the impacts are not, it's not immediate, the impact of that market on what's happening here and now. But both of these markets are incredibly important for mobilizing lending and economic development, both in the good and bad times. Rob, I don't know if you had anything to add. Yeah.
Yes, thank you. And thanks, Eleanor and GTR for including us in this webinar. Great initiative. Following on Carol's comments, I think it's also a matter of timing and need. When the lockdown and in a way the pandemic hit us, the immediate need was for risk or for insurance to stay in place. So we, learning from 12 years ago, and Vinko already related to that or alluded to that as well, we learned a lot of lessons. And one of them was that the worst thing you can do is to cancel limits across the board and create a lot of uncertainty. And as this is not as Vinko also said, a financial crisis yet, but mostly a supply and demand crisis, the immediate need was for the private market to talk to governments and to look at ways on how we can maintain cover and find assurances in this very unusual situation. That doesn't mean that the other segments, or the structured trade segment that Carol talked about, is not important. It's as important, but it's timing. The first couple of months with the short tenors that trade credit insurance has, 60 days, is the average credit rate, and the fact that limits are cancelable, so could be cancelled at any moment. These were the two elements that we wanted to address as an industry first. Once that is in place, and that's starting to fall into place in many countries, we can then also look at the longer tenors and non-cancelable limits business, which will have its own set of problems, as we heard from previous speakers, but not as immediate as in the last 2 months for the short-term trade credit.
Thank you. Well, that sort of explains a little bit then why the focus hasn't really been so much on the single situation business at the moment. What does the single risk market need to do to get the attention of regulators and policymakers as they seek to support the insurance market?
Shall I take that first? I think first of all, more generally, it's always data. It's showing how sizable you are. ECAs, we all love them, they have a lot of exposure, but they are in a way similar. I know that all ECAs are different, but they have an identity and they are recognizable. The private market is very scattered, many players in this segment, and what is lacking, and we've seen that in other areas as well, is supporting data to demonstrate not just the size of the market, but how well the market performs, how well it is underwritten, and how well claimed obligations are met. That is one thing. The other thing I think the private market should emphasize, and cannot emphasize enough, is that there should be a level playing field, and this is where regulators and legislators are very sensitive to. So between the public and the private side, but perhaps more importantly, between the banking and financier side and the insurance side, rules should be accessible and similar, and rights should be similar to all players involved, and the playing field should remain level as much as possible.
Carol, just talking about the level playing field point, what work are member associations and representative bodies doing to give the private market a voice and to achieve this level playing field when policy is being decided?
Yes, so well, really, I guess since the PRA consultation a couple of years ago, industry bodies and associations have really been working quite well in cooperation with one another to address what appears to be a lack of understanding by regulators of the importance of the private credit insurance market. One of these bodies, the ITFA, the International Trade and Forfeiting Association, of which Rob and I are both members and sit on their insurance committee, have a membership which has banks, brokers and insurers. So it's in a unique position to look at issues. And we have been, in that committee, been looking at some of the regulatory changes coming in the finalization of Basel III. And in the context of our efforts in Europe to seek a better recognition for the private insurance market for banks in this framework, we've been looking very much as part of the mandate to educate and inform regulators about our market, because it's been very evident from meetings we have had that the private credit insurance market is not well understood or a priority in the context of bank regulation. There's just simply too many other factors that everyone else is focusing on. And I think this is this lack of appreciation that our market provides in supporting bank lending, which in turn supports the real economy, means it's not really been something people have been looking at in looking at the policy considerations against a COVID background. And I think Vinko mentioned, and it is truly exceptional what measures have been taken in such a short period of time across the sectors in terms of state support to incentivize banks to continue to play their role, introducing government-backed loan guarantees and payment deferrals and things like that. And that common objective has really been to make sure loan payments, modifications or forbearance are effective tools available to banks to deal with corporates when experiencing difficulties for all the reasons that have been mentioned before. I think the EU recognises that the flow of bank credit really needs to be maintained to keep the economy going. And one of the things that we've been looking at ITFA is the discussions that were taking place in the EU about bank provisioning requirements. And this is a classic example of looking at differences between the treatment of an ECA-backed insurance or guarantee and the private market guarantee. So it's a bit of a technical point, but they were looking at, what in Europe, what could be done to incentivize banks at a time when there's not sufficient financing to cover temporary financial pressures. And they want to make sure banks continue to play their part in supporting the economy. And in the midst of those discussions that were taking place, looking particularly at the provisioning requirements for non-performing loan, ITFA commissioned a joint association letter. It was drafted extremely quickly, inside of a week, turned around, and then in consultation with a number of other industry bodies, the IACPM, BAFT, the Berne Union, the LMA and the IUA, and was sent out to 59 different people, including the European Banking Authority and all the EU member states' permanent representatives in Brussels. And the message in that letter was to acknowledge the initiatives that were under consideration because they are significant, but looking specifically at the provisioning requirements for loans, and in particular those covered by ECAs, and to highlight that one should not lose sight also of the private credit insurance market, which also provides this important support to economic activity in Europe. And the key point that we were looking to address in that letter was taking into account what has become known of the CRR quick fix, where some rules are proposed to be introduced into the CRR banking regulation dealing with the prudential backstop. So just by way of very brief context, familiar territory for many of you, but a bank has to judge a loan to be non-performing when it's 90 days past due, but also if there is any forbearance, when there are restructurings or refinancings of distressed debt, a bank has to consider whether or not that loan should then be classified as non-performing. And it's clear that in the current crisis, there's a strong possibility that banks may have to agree forbearance measures, and that would not automatically make those loans non-performing in a temporary situation. So the prudential backstop was introduced in April last year, and this provides for a bank to provision more against a non-performing loan. So once you have decided that it is non-performing, or a bank has decided that, then they have to decide that if they do not expect the loan to perform, even if no payment is yet due, it has to have this extra provisioning. So the issue for the credit insurance market is that banks are required to provision also against the insured portion of that loan. And the provisions start from year 3 of the non-performing loan to year 8 of the non-performing loan, at which point it's fully provisioned. But ECA covered loans have a carve out, and they do not need to provision until you're 8 years in default. So it's true that many non-performing loans will have been restructured or rescheduled within that 3-year horizon, but there are a number of cases where that has not happened, and it is quite possible that against the background of the current crisis, that number of cases is going to increase. And it's always seemed punitive for a bank to be provisioning on a long-term loan on an insured portion, even if the insurance pays out on the original due dates as anticipated under the policy. So that was the very small technical point that was being discussed. And the European Commission came up with a proposed regulation at the end of April unfortunately, the joint association letter content has not been factored into that. I'm sure they had many other things that were priorities that were being dealt with. But the proposal is that preferential treatment for the prudential backstop currently given to non-performing loans guaranteed by export credit agencies will be also extended to publicly guaranteed loans and exposures. So the question of the guarantee being limited now just to public guarantees. So we had some discussion as to whether or not it was worth, as an industry body, taking that further and seeing if we could nonetheless put forward a motion to European Parliament to consider extending that carve out from the prudential backstop also to the private credit insurance market. And that request went in yesterday. It has to be, if it's going to get any traction, it will have to be tabled as an amendment to be discussed by the member states. And today is the day European Parliament is deciding what amendments will be tabled. So quite urgently, again, we had to see if there was support for that and send that out. And now we wait to see. But I think the short sort of issue that all of that demonstrates is just, it's not, the private insurance market is not really a priority and is not taken into account in banking regulation, because there are so many different elements at play and so many other priorities that banks may have beyond looking at the private credit insurance market. But really, I hope that was of some interest to some of you. And I don't know, Rob, if you had anything to add. You'll see from the joint association letter, ACESA didn't put their name to that letter, and I don't know if you had any comments on that.
That's right. Well, we're quite short on time, so if we just quickly, I would like to focus on that and also just get a feeling from you, Rob, and from you, Carol, about how easy it's been for the industry to speak with one voice, given, like you said, it's being somewhat overlooked, and whether the current situation has forced in different societies to work together to share information in a way that perhaps they haven't done before. So, Rob?
Yeah, I'll come back to the letter in a minute. I think your final question is really a relevant one. I think what was triggered by the last crisis and certainly heightened in recent efforts towards the European Banking Authority and PRA and other regulators is that we share a common interest and we share a common goal as an industry, although we are organized in various different associations. Carol already mentioned most of them. They all serve a purpose and they all have their own constituency, but at the end of the day, the overarching goal is a common one. And what we've experienced in the last year or two is a very open policy and open behavior amongst associations where we used to work in silos and in some cases even maybe with some competitive elements in there. Those have all gone, fortunately, and we now share things on the record, off the record, a lot of things in confidence, but it leads to these joint letters that Carol referred to. And I think this is the way forward, and this is the one voice that the industry should have towards the outside world, since we are under-recognized, as we all acknowledge. Quickly on the letter, why ACESA didn't participate, it's also, it's a matter of priorities. ACESA is the only association representing the short-term trade credit. Of the 3 trillion euros that our members have on their books, 95% is short-term credit, and more than 60% of that is domestic credit. Now, domestic trade is totally overlooked in these discussions normally, and certainly not recognized by regulators. So we are struggling to get on the radar in the various countries, and our members have been able to do so. I should give the credit to them. In doing that in many countries in Europe, and we're now also in some countries outside of Europe. So we decided that was our main focus, and of course we support this letter, and we've done so through our membership of ITFA, so that is our position is clear there, but we needed to stay clear on message and clear on focus, and that was the main reason why we stayed out of this.
Thank you very much. This has been really a really interesting session. I'd like to thank all of the panelists who have come together to give us information about what's happening in the market at the moment. And now it's time to hand back over to Jeff for our closing segment, where he'll go through a bit of a summary on the various points raised before running through the questions posed by our audience. So Rob, Carol, thank you very much.
Thanks, Eleanor. Thanks to Carol, Rob, and to the other speakers as well. Now, we've been monitoring your questions as they've been coming in, and we'll get round to addressing these and hopefully providing some answers for the market in these very uncertain times. To do this, we've got two experts from slightly different sides of the market. Anil Berry, Head of Region at Euler Hermes World Agency, and Matt Strong, who's CEO of Credit Specialties at Marsh JLT Specialty. Starting with you, Anil, you're dialing in here. You represent the whole turnover market, which is one of the big three interests represented by Rob and his team, who we just heard from. Interestingly, being based in Paris, you've been back in the office since the start of last week, where a lot of those of us still in London are still in the main at home. Anil, where do you stand on the various issues raised so far, and what comments would you make?
Well, firstly, thank you for hosting the event, Jeff, and the GTR team. And I think it's a really good comments made there. I think I like the comments where mentioned by the Berne Union that we were good to keep capacity back in. We've showed flexibility, and I really think we've come back in as a market and really creating trust to trade. And I think it will be key for all the short-term credit insurers to keep economies going by creating that trust between the supplier and the buyer. I think it's an interesting time for us in terms of how we're going to see the market. I mean, just to give you an idea, we are forecasting there to be a 25% increase in insolvencies in the US and 19% in Europe, and China sort of 15% increase in insolvencies. And so this is in turn going to have a wave of claims that we are expecting in there. To give you a context, just in Europe, we see 7% of SMEs at risk. It's about 130,000. And particularly those SMEs, some of them are not going to kickstart and not going to get back to trade. And we're expecting a wave of claims to come through in the summer. And as an industry, we're getting aligned and getting ready to cope for that.
Thanks very much, Anil. Matt, you're coming from a slightly different perspective. Marsh JLT covering both trade credit market and the structured credit and political risk insurance market, CPRI. What have you made of the conversation here, and what do you see as the biggest challenges being for the market at present?
Thanks, Jeff. Yeah, I mean, when I was looking at this as we went through it, it is a time of unprecedented uncertainty, which of course is the challenges you had in the last hour as to how we try and get our hands and heads around it. And as I was preparing sort of the famous Donald Rumsfeld quote from 2002 about known knowns, known unknowns, and unknown unknowns sort of sprung to mind, because this is a crisis like no other. If you look at what we're facing, you look at the variation of loss estimates, invariably there is going to be a significant wave of losses both on the trade credit side and on the structured credit side, as Anil just mentioned there on the trade credit side. If you look at some of the Moody's, I mean, the historic Moody's corporate global default rate is 4.1% over the last 20 years. That's going to, in their estimations, increase from somewhere between base case 11.3 up to 16.3%. From a country economic risk, we look at our world risk review ratings, there's been 93% decrease or increase in risk in that respect. So there's a lot of challenges out there for a market, but I think also before we, the market is rising to those challenges, and that there is also opportunities to be created. And by drawing on some of the lessons we've seen from prior crises, particularly from the global financial crisis, there's some differences here as well. There's goodwill in the system. There is flexibility. We're seeing obviously the impact of the government stimulus packages as well coming through, both in support of the trade credit market, but also other industries as well, although that then creates differences from country to country as well, and how we navigate and clients navigate that as we go through it. Change in legislation as well, but overall the market, it has come through challenges before as in a robust place, and through any previous economic crisis has actually stood up to the challenge and actually grown in the following years. So there's definitely huge challenges ahead of us. We're still very much at the early stage of the crisis, having now settled into this working from home rhythm. The next stage is as we sort of seek to some sort of return to office, what that looks like and what that means in terms of trading as well.
Jeff,
Thanks, Matt.
Just to quickly add on as well, there was a lot of discussion about pricing, and I think that will be the key about how we act as an industry. I think prices have fallen really for the last 7 years, and so clearly now I think pricing will be looked at, and I mentioned some insolvency figures, so it sort of gives you an idea. If we're forecasting that level of insolvencies, you can see the levels of pricing we look at. But I actually think it's more than just the price we charge. I think the market, with the golden age of digitalization, would look for slightly different things in terms of pricing. I think now the market will ask us for instant prices. They won't want to wait around. You'll see that platforms will come and develop, and I think those platforms will be rapidly developed now. I think as an industry, we'll need to give much more flexibility in pricing. Today, we cover a very narrow spectrum of risks. I think there'll be a demand to cover a far wider spectrum of risks in there, and maybe move to much more flexible nature. And I think our pricing will also have to come with a lot more transparency. I think some of the panelists talked about how we need to be clear about what we are covering and also what we're not covering. I think there's been a big discussion in many across the insurance industry about what is covered and what isn't covered. And I think our pricing would need to cover that aspect in there. Maybe, you know, we have much more flexibility in what we're covering and give different parameters, rather than at the moment it just seems to be one price for all, particularly in the whole turnover market.
Just continuing with that, Anil, where do you see the winners and losers emerging from this situation? Which sectors do you think there'll be appetite for, and which perhaps not? And how will this have a longer term effect when it comes to appetites?
Yeah, I think one of my colleagues described this crisis as a bit of a black hole, in that no one really knows how deep it's going to be in there. So when people say to me that there's certain sectors that have been affected and certain not, I sort of question that. I mean, clearly there's the demand sectors where we've seen a significant drop in discretionary retail. I think it's dropped by minus 22% just globally in their construction, auto, oil. And so those industries we're going to have less demand for. I think the pricing will be much more significant in there. But then, you know, when we look at the industries that have done well, such as the electronics industry, we've certainly seen supply chain issues in that industry. So again, I don't think it's a good and it's necessarily not so appetite as an industry. We see food. I mean, food retailers have had the best ever area. I think again, businesses record volumes has gone up. I've seen it globally about 7% gone up. So I think there'll be certain sectors. IT, software, electronics, who insurers will still have an appetite for, and indeed those sectors where we have lesser, which is auto, construction, oil. What's interesting, still a lot of clients don't credit insure. I mean, the penetration of our product is still in single digits when you're looking at compared to GDP. So I do think that we've seen an unprecedented demand for our products in there. So I think insurers have the option now of picking and choosing which risk to go for. I think they say every crisis doesn't equals risk and opportunity. And indeed, I definitely see there's very much risk and a lot of opportunity in the next 2-3 years ahead.
Thanks, Sam. Just handing back to Matt for a second. Matt, given Marsh's wider viewpoint across the specialty lines, provide some insight into the wider impact caused by COVID-19 in other areas.
Yeah, they can happily try to do so. Obviously not my area of expertise, but if we look more widely, in the market's been, as we've heard already in the last hour, this is potentially going to be the largest event the market has seen. And that's from a combination of factors. I mean, starting off in the very short term in terms of the contingency markets, which Peter spoke about, with the total shutdown on entertainment and sport events, amongst others. So there's, the loss ratios there are extraordinary. If you then look through to the travel sector as well, and the impact there we've seen with the grounding and the ban on travels, and as we go into the lockdowns, and as having been in lockdowns, a lot of chatter and obviously examination around the property area and how BI is applied and what that means, and there's a lot of ongoing discussion in that area. You then overlay certain sectors. I mean, you look at the energy markets, which are already struggling because of the oil price. You put this on top of that, construction, and of course the aviation sector also being significantly impacted. One which will definitely be and is already also having feeling pressure points is the D&O market was already facing significant challenges itself in terms of rate increases. I mean, last quarter this year, even before taking into COVID, I mean, in the UK, from our barometer, the pricings are up to around 46%. So you put COVID on top of that, and some of the actions we're going to be seeing in that area means there will be pressure around capacity and pricing. And we've seen some movements there, and as in terms of even more significant pricing on some of the transactions being renewed at the moment. So when you've got Lloyd's, as Peter said, of $107 billion event without even taking into account investment losses, this is going to be felt across the entire marketplace.
Slightly different track question here. As we know, the insurance markets always had a heavy exposure to and dependence on the commodities sector. And we touched on low oil prices earlier, but we're also seeing concerns around approaches to risk when it comes to trading houses. There have been various high profile cases, financial difficulties, in some cases, trading houses going to the wall. With COVID-19 also in the background, is this a bit of a perfect storm for the insurance market, particularly that single situation market that you represent?
It's a good question, Jeff. I mean, we were already trading in challenging times. Whilst the market was growing and there was the bubble, and we were seeing significant growth as a market as a whole, there were challenges and losses coming into the marketplace. And if you go back to last year, when you take things like external reference point, whether it be the World Economic Forum, where they do their annual survey, and you look at the top 7 out of the 10 risks named by the leading executives around the world are directly related to our marketplace. And even more so now when you look at their latest snapshot, overlaying the COVID lens on top of that. So we were already in pretty volatile and fragile times in terms of trading. When you put on top of that some of the losses we are seeing in the trading environment, that puts more pressure, but it does then come back down into, as well as Sean said earlier, looking at the relationships and working through it. So I don't, perfect storm is probably a step sort of too far, but yes, it sort of adds to additional challenges that we face at a time when we're facing one which we've never faced before.
Got probably time for a couple more here. I'm mindful of people's time and of course the time allocated for this webinar. Perhaps one for you both to come in here. What are your experiences when it comes to efforts to exclude COVID-19 from policy wording? Someone's asked this. Maybe some of the panelists may want to come back for this as well, but keen to hear what you both think of this question.
I think maybe I just step in. I think I alluded to it. I think insurers now will be pushing much more to say what is covered and what isn't covered under a product. And I've certainly seen that in the whole turnover market over the last few years now, where wordings have provided much more clarity, particularly when we're working with banks in terms of what is covered and what isn't covered. So I don't think COVID will be excluded in there, but I think certainly insurers will need to look at this when they're pricing risk. I think pricing, we have big pricing teams, and when we're looking at risks, we plan them out for the year ahead. And when you're looking at COVID or these type of epidemics, they seem to be becoming much more common now. So I think we'll need to price it into our risks and make sure that clients are aware of it and they see the value of it and therefore support the pricing that goes with it.
From our view, Jeff, across the whole credit spectrum, it shouldn't be excluded. There doesn't need to be an exclusion. There can't be an exclusion, frankly. On where we have seen some chatter around it is on the political risk side. Again, our view is there is no need for a COVID-specific exclusion. There's a bona fide language in there already, which addresses that. And so, our viewpoint is there is no requirement for it in our marketplace. We have seen, of course, more in the wider market space, a pushback from other classes where they are arguing that a COVID exclusion can come in or should be in policies. And we're aware that different insurers are taking slightly different views on that as they go forward.
Great. And a final question I think we should close on here, and a nice broad bit of crystal ball gazing for you both. What lessons do you feel the industry will ultimately learn going forward from this episode in time?
One is that working from home can work. I think the need for the right trading platforms in terms of electronic and digitalization is going to over time. I think what is very much the lessons which we learn and we continue to learn and get repeated is relationships are key in this type of thing. We're very much working together as a marketplace. And I think also what is key is the role the market has in helping as we navigate through, but also to support the economy. And The market's performed through the financial crisis, has delivered on that, and our expectation is we'll continue to do so and be part of the rebuild and play a critical role in that rebuild.
Anil, anything you'd like to add to that as a final comment?
Yeah, and I think I'd just like to echo some of the comments that was made by the panel. I think I'm really proud of the way the industry managed to create that dialogue with governments, and they realise the key importance in terms of kicking start and getting trade going and getting the economies back on, and they realise the importance of trade credit and the role that we play. I think increasingly maybe I think you see the banks lobbying, and I think we've really followed some of their actions and really now had that dialogue. And I hope this dialogue continues, because I'm sure there'll be other crises that will come along, and then how quickly we work together I think is important. Again, working from home, I think it's something that I think I found it easy, but maybe my family haven't, so I'm not sure what I can do about that. Hence why I'm probably back in the office quite early, back in Paris. But so yeah, I probably learned to be a bit more humble with them.
Seems like a good place to finish. Thank you both. That brings today's webinar to a close. Many thanks to all of our speakers and to Eleanor for helping lead those discussions. We're sorry unable to get around to addressing everyone's questions. I think our speakers are known to most, and do feel free to get in touch. There's some details on the GTR website as well, those LinkedIn connections, so I'm sure they'll be happy to follow up and future discussion. Please also listen out for further announcements regarding GTR's webinars, other exciting new activities such as our virtual events as we look forward to over the coming months. And do also please follow our unrivaled GTR editorial coverage at www.gtreview.com. But until then, take care and we'll see you next time.